when you put on a lens which says that I want to focus on 10 baggers or 100 baggers, um, the equation changes and what you look for changes. So, for example, if I looked at a business like Amazon, which is a wonderful, exceptional business, and of course, uh, Nick Sleep was very smart to have recognized Amazon very early and understood many things about its incredible moat before most of us did. And in fact, one of the reasons he shut down the fund was that he had made a significant investment in Amazon. It might have been a fifth of the fund in terms of invested capital. And then of course it was going up in value and becoming a larger and larger portion of the fund. And the British regulators questioned the the risk management and the portfolio management. That was one factor, but his partner and he kind of looked at each other. They were managing about 3 billion. They had become wealthy beyond their wildest dreams. They did not want to sell Amazon. They did not want to take that concentration down. And so what they said is, we'll return all the capital. And they did. So in 2014, they wrote to the investors and said, we are kind of hanging up our boots and, here's your capital back. And Nick Sleep basically told his investors that I am going to take my proceeds and put it into three businesses. And the three businesses he put his money into, all his money into, were Berkshire, Costco, and Amazon. Even if you ignore what happened to Berkshire and Costco, if Amazon was a third of the pie, that would have been an incredible home run. And he told his investors when he returned the capital that you don't need to pay us any fees. You don't need to read our boring letters. Just buy these three stocks with the capital we're returning to you. And warm regards.
Hey guys, welcome back to the channel. Today, I want to talk about Nick Sleep's legendary investment in Amazon, which was Nick's largest position and his best performing stock in terms of returns. From 2008 until now, Amazon stock has been more than a 600 bagger, which is a compounded annual return of around 35% a year. I thought it might be interesting to go back through some of Nick's letters from around that time to see what he was thinking about the business and why he thought Amazon would succeed when everybody else was writing them off. So let's get started. After my last video on how to find multi-baggers, I had some questions in the comments about how it works and how do we know which companies to pick. It's a really great question, so I thought it'd be fun to go back to 2008 and analyse Amazon through Nick Sleep's eyes, while also using part of the framework from my last video. Now, Nick first bought Amazon stock around 2004-2005, but I think 2008 is when he really loaded up on Amazon, after the stock price fell 60%, so that's why I'm using 2008 in the example. At this point in his career, Nick had evolved from buying and selling 50-cent dollars to more of a Charlie Munger approach, where you focus on high quality, high return businesses with long runways. So while he may have got Amazon for a great price, these two factors would have been the main focus of his analysis. Now, when it comes to judging the quality of the business, there's a few ways you can go about it. The simplest way is to look at the return on capital employed and the return on incremental capital employed, which is used by Warren Buffett and Nick Sleep. For fun, I decided to fill out my spreadsheet for Amazon to see the results that Nick Sleep would have seen back in 2008. If you're new here, I made a full video where I explain everything I just mentioned and how this spreadsheet works, and you can also download it yourself if you're interested. So I went through a bunch of old annual reports to get these numbers, and essentially this is what Nick would have seen when he was looking at Amazon's return on capital back in 2008. If we look at their overall return on capital employed first, which is just free cash flow divided by total capital employed, their ROCE was a massive 30%. So even back then, Amazon was a really high return business. And if we look at the incremental capital and the reinvestment rate, in the 5-year, Amazon's return on incremental capital was 30% and the reinvestment rate was 86%, giving them a value compounding rate of 25% a year. Now, if we look at the 10-year, over the long term, the results were amazing as well, even though there was a few years when Amazon wasn't producing any free cash flow. Over 10 years, their return on incremental capital was over 33%, and the reinvestment rate was 110%, which gave them an insane 37% a year value compounding rate. So Amazon passes the first test and was a very high quality business with exceptional returns on capital. For the next part, we need to look at the management and their capital allocation decisions. In his letters, Nick speaks incredibly highly of Bezos and his capital allocation, especially when it comes to giving back to customers through lower prices and investing in projects that may not be profitable for many years. Something Nick talks about extensively in his letters is how Amazon has a unique business model that intentionally keeps prices low so they can scale the business and then share the scale benefits with their customers. And he famously named his business model Scale Economics Shared. Nick says, the simple reality for many of our firms is the virtuous spiral established when companies keep costs down, margins low, and in doing so share their growing scale with their customer. In the long run, this will be more important in determining the destination for our firms. He also quotes a paragraph from one of Bezos' letters, where he says there's two ways to build a great company. One is to work very hard to convince customers to pay high margins, such as Colgate and Nike. And the other is to work very, very hard to be able to offer customers low margins, which is the Walmart, Costco, and Amazon model. Bezos says they both work, but Amazon is firmly in the second camp. They'd rather have a large customer base with small margins than a small customer base with higher margins. Nick goes on to say that although Bezos doesn't mention it, one reason he prefers Amazon to be a large company with small margins is that if he shares the efficiency benefits that come with growth with his customers, he turns size, frequently an anchor on business performance, into an asset. In other words, the moat surrounding the firm deepens as the firm grows. What makes the scale economy shared business model so powerful is that it creates a flywheel effect, where more customers lead to scale benefits, which lead to lower prices, which lead to even more customers, and on it goes. Again, he quotes one of Bezos' letters when talking about price givebacks. Bezos says, as our shareholders know, we've made a decision to continuously and significantly lower prices for customers year after year, as our efficiency and scale make it possible. This is an example of a very important decision that cannot be made in a math-based way. In fact, when we lower prices, we go against the math, which always says that the smart move is to raise prices. Our judgment is that relentlessly returning efficiency improvements and scale economies to customers in the form of lower prices creates a virtuous cycle that over the long term leads to a much larger dollar amount of free cash flow and thereby to a much more valuable Amazon. This is a perfect example of scale economics shared. Most investors assume that keeping margins low is stupid and that a low margin business is a low quality business, but Nick disagrees with that argument completely. In his letters, he talks about something called heuristics, which are essentially just rules of thumb. He says that in normal life, heuristics generally work, but in the stock market, heuristics can limit one's research. Nick reckons the wide use of valuation heuristics in the industry is quite bizarre. A few common heuristics for investing are things like a high PE equals overvalued and a low PE equals undervalued. And another common one is low margin equals bad business and high margin equals good business. Nick talks about how investors incorrectly apply heuristics to Costco, which applies to Amazon too because they're both scale economics shared businesses. He says the first heuristic is that the company has low margins, meaning it's low quality, with lower profit margins than competitors. Nick says that's true, but that's the point. The firm is deferring profits today in order to extend the life of the franchise and build a wide moat around the business. Of course, Wall Street would love profits today, but that's just Wall Street's obsession with short-term outcomes. So essentially, Costco and Amazon could easily raise prices if they wanted, which would also give them much higher profit margins. But they're keeping margins low on purpose by lowering prices and giving back to the customer. It sounds counterintuitive, which is why most investors just overlook it and they apply these heuristics. And this is exactly why 99% of investors were ignoring Amazon, and they dismissed it as having low margins and being overvalued. Heuristic number 2, it's expensive at 24 times earnings. Nick says if they wanted, the firm could earn Walmart margins by taking prices up a little, in which case the firm would be on 11 times earnings. But would the business be better off as a result? We think not. This is another one that applies to Amazon, and I'm sure there were many investors who looked at Amazon in 2008 who dismissed it as being overvalued because of a high PE ratio. Overall, I think Amazon's management are quality, and they make great long-term capital allocation decisions, so they passed the second test. And again, I think Nick Sleep would have been really impressed with Amazon's management back in 2008. Alright, so far, we know that back in 2008, Amazon was a high return business with a high quality management team who had a long-term focus. The last part of the framework is to look at the runway for the business, or as Nick Sleep calls it, destination analysis. I'm not sure anyone, other than maybe Bezos himself, knew back then what the Amazon of today would look like, with the massive growth in Amazon Prime, and new adjacent businesses like Alexa, Prime Video, and AWS. It just goes to show how hard it is to predict the future for businesses, even when you really understand it like Nick Sleep did. So going forward, we can try to take lessons from these examples and try to find similar businesses with the same characteristics, preferably when they're still early in their life cycle and there's still a lot of runway left. Nick was skilled enough to see that Amazon had a long runway before anybody else. And even though he didn't know exactly where the runway would lead, he believed that because of the high return on capital, the management, and the business model, that the destination would be very favourable, especially because they had a pretty small market cap of around 20 billion, so there was still a huge amount of room to grow. All that's left is to buy shares at a reasonable price and trying to take advantage of stock price volatility. Like I mentioned earlier, even though he owned a small position already, and even though he may have liked the business at $100 a share, he patiently waited until Mr. Market offered him a bargain price at $40 a share. I was curious though, and it turns out that even if you had bought at the highs of around $100 a share back in 2007, you still would have generated a 26% return over the last 14 years. But Nick buying at a bargain price made his returns even better. I think the biggest lesson we can take is, although Amazon's been a raging success, what they achieved was pretty unknowable back in 2008. But as long as it's a high return business, with quality management and a lot of room to grow, you don't need to know the exact destination to know that the destination will be favourable. And according to Nick, one just needs to have the patience to wait. So that's Nick Sleep's analysis of Amazon, and I hope you found it interesting. Unfortunately, there was a lot I didn't get to mention in this video about Amazon. So if you're interested, I highly recommend reading Nick Sleep's letters. If you enjoyed the video, please hit the like button as it really helps the channel grow. And if you watched the video all the way to the end, thank you so much for watching. Let me know in the comments below if there's any other multi-bagger examples I can learn from, preferably 100 baggers or more. And as always, this video is not financial advice and I'm not a financial advisor. So please always do your own research before making any investment decisions. So that's it for this video. Thank you so much for watching and I'll see you guys in the next one.